in the middle of 2021, China's government decided to restructure the economic growth model to focus on new growth engines. But when that decision was made, people did not realize land sale is by far the most important foundation for Chinese economic growth engine. If you shake that variable, you shake the foundation, and that cannot be reversed.
Welcome to another compelling episode of World Ledger with Coco Key. This is your gateway to fresh global perspectives and insightful discussions. Whether you're a curious mind, a global citizen, or a lifelong learner, you're in the right place to discover how blockchain innovation is shaping the world beyond your borders. Everything on this podcast is for informational and educational purposes only. It represents personal views and opinions and does not constitute investment or financial advice or recommendations.
Shengbei, thank you for joining me today to share your views and insights about China's economy and global outlook. China's economy can seem complicated, making it hard for outsiders to get a clear picture of what is happening there. Some people are worried about its economy because of problems like real estate market going down, consumers not spending money. Others are worried about foreign investments leaving and less support for private businesses by the central government. Despite all these challenges, the Shanghai Composite Index has been creeping up from its low around 2,700 last October to about 3,300 today. If someone asks you about China's economy, what key indicators would you suggest him to focus on?
Of course, at the end of the day, it's a combination of monetary policy, fiscal policy, and global macroeconomic situation that are changing pretty rapidly. All of that point to a very interesting twist in Chinese story. First, China went through a very interesting change in 2021. The growth engine that supported China's economic miracle stopped. 2021 is a turning point. That's the first point I try to make. The second point is after that, the long-term decline, both for property market and the economic problem, will be for a very long time, probably a decade or more. Thirdly, many of the solutions not helping the root cause of the problem. Some of that may even worsen the problems. Having said all that, back to what you said earlier, starting September 24th of 2024, things have really changed for the better. So if the question is how it's doing now, in fact, it's doing relatively well.
You mean starting from 2021, there were already signs of downturn of China's economy, which could be manifestation of structural problems. What do you think are the root causes of the downturn of China's economy and all the changes suddenly happened in China?
China has a very unique growth model, different from probably all the other known models the world has ever seen. Everybody knows how big the state-owned enterprises are, how big the role the local government can play in the economy. What China was able to achieve is combine public ownership with tightly controlled financial market. That system allowed China to do something no other country could do, which is sell land. It allow the local government to sell land at ever higher prices. The banks lend into very highly collateralized property market. Developers to build a lot of properties and households taking on debt and invest in the property market. That serves as a virtuous circle. This process caused the land sale getting bigger and bigger. The peak for that was in 2020. At that time, the gross land sale in terms of total GDP was between 6 to 7%. In order for Chinese model to succeed continuously, land sale versus GDP ratio must rise. If you have everlasting increasing land sale to GDP ratio, all the previous investment, even though they were not yielding as highly as people expected, would not be a problem. However, in 2021, that broke. In 2021, land sale to GDP ratio started to go down. It's also reflected an important shift in the government's approach of the housing market. They believe that the housing market is not for speculation. However, for that housing market-driven economic model to continue, that speculation, in my opinion, is what drives the whole growth model. I wrote a piece of paper in 2021 using economic model called the Kleski-Levy profit equation. I was pinpointing why 21 was a turning point and why the bears on China were wrong and why the bulls will be wrong, because it's that uniqueness of the model that gave rise to miraculous Chinese growth. But that model shut down in 2021. And that will not be able to restart for a very long time.
That's a very interesting point, that GDP and real estate market growth have to be in a certain range. I thought China always had three legs of growth. The first, of course, is real estate. Second is infrastructure investment, because China invested so much money in building infrastructure, high-speed train, railroads, etc. And the third is the export. These three drivers have been driving China's GDP growth and economy growth. Why the ratio broke in 2021?
That's exactly where this Kleski-Levy profit equation would shed some light into this discussion. Typically, we look at any economy, we look at consumption, export, import, and investment. The two of the elements you talk about, one of them is household investment in real estate. Also, you talk about infrastructure investment, typically done by the government. In the past, people talk about how China grow better versus the rest of the world because of the investment and export-driven approach. I contradicted that point of view by using Kleski-Levy equation, corporate sector profit equal to investment minus household saving plus fiscal deficit plus net export, current account surplus, plus dividend. The equation can be derived both from the GDP expenditure side and the income side. Most growth models depend on you make some money, that money can be taxed, and you can save, you can spend. There is a circuit of money. When you sell a piece of land, that is a financial transaction. Or if you sell a house to somebody else, that's a financial transaction. GDP from that is actually very small, other than broker fee or something very, very small. Financial transaction by itself, whether you sell stock or bond or property market, is not part of GDP. But what China was able to do is by selling into increasing housing market, it realized higher proceeds as percent of GDP keep on going up. When that goes up, local government can use that proceed to invest in the infrastructure you talk about, including high-speed train. So the investment process was able to invest in, let's say, factory parks or railroad, high-speed trains. All of this can continue because government can have this free money. This free money allowed the government to invest with decreasing investment return. And despite all the problem, the bubble can never burst because of that inflow of money. That's why I made a very important condition for the growth model. That growth model must be based on increasing land sale to GDP ratio. But if that land sale to GDP ratio decline, which happened in 2021, the whole model would immediately went reverse. And in fact, the acceleration on the reverse will be astonishing. That's how I predicted that. Of course, that lead to a whole sequence of projections for the bond market, the equity market, the real estate market, and the global trade-related issues, essentially disintegration of the growth model.
You mentioned there is an equation. Can you explain that equation?
The Kleski-Levy profit equation is created by two economists. Mikhail Kleski is a very famous economist. Many people regard him as one of the best ever. He created the entire theory similar to Keynes, but he wrote in Polish. That's why he was not as well known as some other bigger names. He discovered this profit equation independently of Jeremy Levy. That's why the equation is called Kleski-Levy profit equation.
What happened 2021 when the land sale suddenly decreased?
It go down for the the reason of demographics, also the slowdown of urbanization, and secondly, property market become more and more important. When people sell to each other, they do not give the proceeds to the government. The other issue is the housing market has become so hot over so many years, it become a burden to the economic growth. In the middle of 2021, China's government decided to restructure the economic growth model to focus on new growth engines. But when that decision was made, people did not realize land sale is by far the most important foundation for Chinese economic growth engine. If you shake that variable, you shake the foundation, and that cannot be reversed.
When the government decided to drive a new economic growth engine, did they have a clear idea what the new engine would be?
China did think about how things would change, but since it's investment driven, they were redirecting money into some emerging sector of economy, trying to let them take over. But when they decided to do that, it created a bunch of other problems. Unlike real estate market, which is a financial investment, most people depend on price appreciation. If you invest in real economy, you need profit and cash flow. That transition is not such an easy transition.
China's renewable energy sector has been growing well, and look at its EV, electric vehicle industry. It's doing very well. Is it part of the effort of China's transition from real estate driven to a new sector? For example, renewable energy driven economy, but that sector is not big enough to recoup the loss of the real estate economy.
It was definitely part of the plan back in 2020, 2021. In fact, it's still part of the plan. If you look at the growth of the EV industry and also the solar-related industry, they have been growing pretty fast. What is unique in this setup is this idea was working for a little bit in 2020 and part of 2021. But what happened is the external variable from land sale is declining. And that is irreplaceable. That number by 2020 was roughly 7 trillion RMB. It's a very big number. It's growing pretty rapidly over a decade and a half. That sale is actually equity for the government. From there, you can leverage up with debt, whether you use a fiscal deficit model, which is fundamentally based on debt. Equity-based financing can get more and more debt, but debt-based financing requires a far more supportive monetary environment, also global environment. The new industry, at the end of the day, is still a traditional growth model. The size itself is not as big as the property market. More important, the way it grows is very different from the Chinese way of property market-driven growth model.
It seems the property-driven or real estate-driven economy is broken. Where is China heading to? Or where do you think China's economy stand? Has it bottomed out? Does it still have a long way to recover?
We talk about that land sale variable, the equity for the government. From there, you can leverage up to get more asset, have more debt. But now that process is going to reverse. The future growth potential will cool off dramatically. For the investment perspective, the biggest component is government. The second one is individuals or household buying the property market. For the government to continue the economic growth, they must invest into state-owned enterprises in a declining economy. Decision by the government to invest into state-owned enterprises or invest through the government arms cause a distributional effect. The private sectors and households have less income, slowing down economy. Distributional effect is very difficult to handle. The government needs enough revenue to drive the centralized approach, whether through the central government or through the local government. With reducing revenue source, there's going to be a higher taxation into the economy. People have to relinquish some of their property right to the government. That's another dampening effect on the real estate market. This downward spiral cannot stop. I don't expect that to stop anytime soon.
Do you think China will experience Japan's economic stagnation in the 90s, which took Japan over 30 years to recover from?
The global situation Japan faced in the 90s was substantially more favorable than China is facing today. Japan, of course, have some policy errors at that time, which contribute to the problem. I would say China's internal growth engine is far more dependent on real estate than Japanese model. That means it will be very difficult to recover. Because of dependence on the real estate market, the government play a much bigger role in economic activity than other countries. That may require a much bigger restructuring. If you purely focus on those two angles, things will not be able to recover for a very long time. While also going through global regime shift, things will change in far more unpredictable way in the future years.
When property market goes down, private companies and individuals get hurt. Is it the reason that Chinese government has to turn to the state-owned enterprise in the hope of boosting the economy?
Correct, because the slowing down by itself would hurt all the people equally. The downturn, the enterprise that has access to capital, which of course improve your profit margin, improve your cash flow, would thrive. In this downturn, the money flow into the state-owned enterprises or the government-sponsored strategic investment. If you don't have access to capital, you will suffer. That is why the private sector is struggling.
Considering the economic challenges China is facing, has government done anything in fiscal policies or monetary policies? Do you anticipate any measures from the central bank or the government to stimulate and support the economy?
China absolutely have done a lot. I changed my view on short-term basis, maybe medium-term basis, starting last September. If you ask me now, I'm actually long the Chinese equity markets, mostly through the US listed ADRs, right? I'm not giving anybody any advice in terms of trading because everybody should make their own decision. My view changes September last year, first based on a monetary policy change. The central bank have done a lot to support economic growth. From 2021 to today, they have lower interest rate to support state-owned enterprises better than typical household or private sectors. They lower the cost of funding that somewhat stabilize the problem. The reason the stock market have such a huge turnaround in September 20 last year is because central bank announced an interesting policy shift. They announced a 500 billion RMB swap program. The second one is a 300 billion RMB stock repurchase program. By announcing these two programs, it directly support the debt accumulation for people who try to invest in stock market. I worked in China for a few years, coming back in 2022. I was trading successfully over there. Stock market depended on how much margin loan outstanding. What the central bank essentially was doing, allow the margin loan growth to be very easy. What China implemented is not a QE, but a demand-driven credit allocation specifically tailored to stock market. Success of this caused market to rally 15-20% within days. The government realized there's some downside risk. This policy increased liability side, increased the risk of stock investor. If things don't go well, you can do poorly. They probably realized that problem too, so they try to downplay that. The fiscal policy that's supposed to help the market right away didn't deliver the promise. So stock market came down a little. I still believe fiscal policy will be helpful. There's going to be higher tariff on Chinese import. That will be the US policy. It will naturally lead into importers buying more Chinese product in fourth quarter of 2024 and early this year before the tariff take effect. So when you have that type of short-term economic boost to the export sector in China, there's no reason to deliver actual boost in economic growth at that point. Secondly, you don't know how the tariff policies will play out. This year, there's game theory on the macro level, strategic level, even ideological level. Oh, from that point of view, China not delivering fiscal policy boost to the economy in the first quarter of 2024 is understandable. But now, if you look at this year, all China needs to do is deliver some marginally positive fiscal policies that support people's income for the market to continue to rally. So that's why I temporarily shift my viewpoint. And of course, we're playing with so many variables at the same time. My viewpoint is also based on that the game theory-based macro competition environment, I would say is only for short term.
That explains why the Shanghai Composite Index has been creeping up. Does that help the sentiment in China?
I think it does. That will help the market and help people's income, even on temporary basis. Overseas Chinese stocks, they've been going up a lot this year. Previously underperforming market, European markets, Hong Kong, they outperformed too. China did well last year, but all the performance came from September 24 to October 10th, a very narrow 2-week window. If you look longer term, they have not done well. This year is a very unique year. The outperformance reflects American or overseas investors' preference. They allocating more to the Chinese stocks, which they did not do. The allocation by itself conserve the foundation for some rally, and that rally can serve as signal to other related market. So that's why I would say starting from December, especially January this year, I started buying on dip. In fact, my own opinion can expect even higher rally going forward for some time until we have a bigger shift in fiscal policy and structural changes. Everything is driven by U.S. policies at the end of the day.
Has the central bank done anything constructive?
Yes. They lowering the interest rate to very low level that support the overall growth, at least stabilizing the economy. In the summer of 2024, recognizing that financial firms are putting money into the long-term government bond, which drive the interest rate to ever lower levels. They figure out a way to borrow some bond from financial firms and sell in the market to limit the decline of the 10-year government bond yield. However, monetary policy response in China play a secondary role. Remember, we talked about the unique growth model China has that had nothing to do with central bank. We're talking about this particular government-driven investment process can only happen in China. None of that can be impacted by central bank policies. All the central bank did is stabilizing the environment.
U.S. interest rate have been staying high for a year or two. Do you think that the high interest rate in the U.S. has had some impact on China's economy? And if the interest rate stays high, how would China be affected negatively by this high interest rate? I don't expect the U.S. interest rate to come down soon.
The U.S. interest rate, especially after they were hiked up in the middle of 2022, have a global chilling effect in terms of how everybody can grow. China's interest rate going in the opposite way. That obviously is stopping overseas bond investors from going into China. It probably play a role for some capital outflow. And furthermore, because of high interest rate, funding option become very difficult to achieve for some Chinese corporation from dollar market. However, the point I made earlier is China's model is so unique, it's fundamentally not a monetary driven issue. It's actually how the system is set up. That system nowadays depends on how to export more. That's why if that tariff is going to play into the reduction of Chinese export, that have far bigger impact than the interest rate policies. The trade bloc has been redesigned by many players, including, say, CPTPP, the declining role of WTO, especially with US trying to restructure global trade system. All that play a far more important role in currency movement, economic growth, possibility. That's why I would downplay interest rate. They are secondary to other more important variables.
I spoke with some people outside of US. They were complaining about the dollar hegemony. US could keep printing money and making other economies struggle with high inflation. They hope that US could become more responsible because it's a reserve currency used by the whole world. I hope that we'll figure out a way, be more physically responsible and see whether we can reduce all the spending.
I appreciate your candid opinion on this one. And I would suggest everybody read a few publications, at least some of them are the viewpoints expressed by Scott Bessent. He talked about his famous 333 program, which kind of borrowed from Japan, three arrows idea. I suggest people read another article published 2 to 3 months ago by Steve Moran, chair of the Economic Council under Trump. He wrote a very interesting article, User's Guide to Global Trade System. The whole article was based on multiple analysis. First, he used the Triffin dilemma, talk about the dollar reserve currency status. Most Americans don't get enough benefit from that. To talk about how we can restructure that through a tariff-based approach. And he even talked about a different approach, which is essentially a Mar-a-Lago Accord type of approach. And if you really go with that approach, that means people who trade with the United States have to pay to be sitting on the table. If you want to be a part of Pax Americana, you will need to pay for that. This approach is actually more challenging than the sound fiscal or monetary policy. This is re-engineering an entire system, which is huge if it's achievable.
I'm going to add the two articles to the show note. People can read about them. Let's shift to talking about gold, because China has been buying up gold in the past year or two. What is your observation of what's happening in terms of the gold rally?
I am a strong believer of gold rally, probably from 2020. At that time, I was in China. I advised many people to buy physical gold when they declined to $1,400 an ounce range. I keep on asking people to buy. I think the gold went through different stages of growth. First, initial growth was based on the negative real interest rate when interest rates were low and the QE was so much and inflation was high. So it's clearly super bullish for gold. So that's easy decision. But from 2022 to 2024, especially 2022 and 2023, when the interest rate were going up so much, did not go down. And of course, when interest rates stopped going up, gold started rallying again in 2024. The reason we stayed bullish the whole time is there is another important transformation because many central banks are buying, include Turkey, Russia, Poland, China did too. If you look at reserve currency, people tend to focus on how much official reserve a country holding and how US is such an important thing. But my framework would look at it in 3 layers. The first layer is almost going back to the last 100 years. It's a transactional trade-based layer, which is reserve currencies used for facilitating trade. The second layer is how petrodollar started when Arab countries sell us oil, reinvest the money into the bond market. That also leading to the Asian countries accumulating reserve in the 90s. All of that is based on official reserve. But there's a third layer. We have a far better financial system, whether it's NASDAQ or Bitcoin. All that is a complicated financial system dependent on US dollar as a reserve. Reserve's true benefit is financial market. That leading to an interesting divergence. If you look at transactional global trade, the US dollar's dominance, in fact, is weakening. because more and more European country trade with the euro. China's also started to do a lot of RMB based on transaction. If you look at financial market based approach, the US dollar is gaining strength. Those two things are diverging. But gold, interestingly, can serve very well in a traditional trade-based economy. There is a need for a medium of exchange which people can agree on because of the multipolar development in the global trade system. Gold would do very well in this scenario. Today, US dollar liquidity is on a peaking stage, which require a few rule changes to provide additional liquidity for the continuous strength of the market. Before we see any of those development, gold is supported by a different angle. If you go back to what Besson's talking about monetizing US assets at a balance sheet, Miran's article talking about trying to revalue the gold, there is possibility of using gold as collateral to financing US government. There are many ways to do that. I don't believe we'll sell the gold, because if you sell the gold will instantly decline a lot. I think that would be not a good approach. But using that collateral and using gold special feature to get it cheaper than market rate, helping reducing the long-term bond issuance, that essentially almost like the QE, but driven by the Treasury Department. If you do that way, it's highly bullish for gold. That possibility is what drive up the gold prices recently.
Have you followed Bitcoin? Bitcoin price is now pretty similar to gold by kilogram, around 95,000 US dollar. The government is looking into whether to create Bitcoin strategic reserve. But of course, Bitcoin's market cap is only 10% of gold. So it's a long way to go, definitely not big enough to play the role of gold.
I like Bitcoin too, but I noticed there's some difference recently. Bitcoin has far more beta than gold, right? Gold is, relatively speaking, boring compared to Bitcoin or other crypto asset. The strategic reserve idea, US government don't have a lot of Bitcoin. I'm not sure they own enough Bitcoin to make that an important play. I have a little reservation on a short-term basis related to MicroStrategy. Because MicroStrategy announced the 21-21 funding plan in the combination of convertible bond and equity offering. The reason that is challenging on short-term basis is they bought a lot of Bitcoin in the first quarter of 2024. When you offer convertible bond, for the previous guys to do well, they need to be set higher conversion prices. That typically happens when the stock prices have gone up beyond that level, but that hasn't happened. If you start to offer equity, that have dampening effect on the stock prices. You offer convertible bond, which is the smart way of utilizing the stock market. You basically leveraging on the Bitcoin's volatility. MicroStrategy is a leverage Bitcoin in some way, have bigger volatility. By selling convertible bond into the future, on very high conversion prices, you are taking advantage of the volatility. But that is dependent on that variable. The stock price needs to be higher than before, which has not happened. Further funding based on convertible bond is a question. And thirdly, the offering of convertible bond is so large. The convertible bond have a unique feature. When stock go up, convertible bond traders to sell the underlying stock. When stock go down, they buy it. So they actually decrease volatility in the stock until you go through the stage where it's going to have a gamma squeeze. When you go through that range where it's near the conversion price and market will push it based on some additional variables, which happened last September and October for MicroStrategy. They bought a lot and convertible prices, they probably couldn't issue that easily for the next few months because of such a high amount outstanding convertible bond doing this gamma trading. And all that limit volatility of the stock, this financial aspect, gave me a little bit hesitation on short-term basis.
Macroeconomics 101, when interest is high, gold price always goes down, but it doesn't happen. Is there anything that we need to pay attention to for this very unique situation?
Gold has defied gravity in this case. They always put back due to interest rate hiking. What I believe happened in 2022, the gold margin went down, stock market and Bitcoin went down a lot during that time. I stayed bullish throughout the time for gold, but I was on the bearish side for NASDAQ and Bitcoin in 2021, no matter how high they were. Gold was much more stable. There are greater use of other currencies which require stronger medium exchange. Global trade system was initially designed to be gold-backed. Before World War II, a lot was based on the gold standard. Gold standard from domestic point of view is highly deflationary. Nobody want that. But from global trade perspective, it's the effect of balancing out the trade. Because we are in an era, everybody need to trade more with non-dollar currency. There is implicit moving toward gold as foundation. That is becoming a recognized principle by many governments as we speak. In fact, it has started quite a few years ago when China was trying to use RMB to be a global trade currency. People realized if we invest in RMB, what's your financial market? Even China made progress in that front by using some kind of direct investment program. If you invest in Hong Kong, you can do this Hong Kong Shanghai direct thing, which allow you to invest into Chinese market, whether it's the stock or bond. But that is still not the same as the US market, even to a lesser degree, Euro-based market. Because of that, the need for something tangible and exchangeable has improved. People believe there's a way to convert the Chinese RMB earning into gold. Gold become part of the global trade transaction. That's why gold is going to be in high demand, and all the government are buying.
That makes a lot of sense, because that is the question always back in my mind. If China's trade partner holds so much RMB, there is no capital market, no financial products for them to invest in. That discourage China's trade partners to use RMB. But if they can use gold as a medium and to convert the RMB into gold, that will facilitate RMB as a trade currency.
I talk about global reserve currency from my angle, which is different from the traditional driven dilemma angle. If you look at reserve holding angle, dollar was losing initially to euro in the 90s, but since then stabilized. But if you look at financial market, by the global need for dollar, especially investing in the legal framework that United States provide to the outside world, dollar has been strengthening. US dollar hegemonic position has been going up. You have to look at the right angle. That's why by splitting into multiple angles, you can see a clear-cut case. In addition, everybody's issuing more and more money. There's debasement issue. But remember that debasement issue was also why Bitcoin was highly sought after. They were down in 2022 and up a lot more than gold. I believe there's different driving forces behind the two products.
I could sum up from what we just discussed. For the gold, it will continue its upward trend.
Yes, of course, depend on whether we do the monetization. Nobody knows. It's all based on speculation. If they do, though, the market will go up a lot. But if they don't, they should go down, in my view, because right now we are potentially at the turning point, unless the Fed or Treasury Department do something to help the liquidity condition, which help all the market, like gold or crypto or the stock market, they help everything at the same time. But if they don't, especially gold should go down, but downsides are limited, even though that liquidity-driven downtick is probably a greater possibility than overall uptick for the time being. This year, we talk about the macro game theory-based approach, which means no trend can last for a very long time. But gold could very well be an exception. I would stay long.
Since we already touched multiple asset classes, maybe we can go back to the last question. How is the 2025 economic outlook different from the past 2 years, and how might it impact various asset classes, including gold and stock market and even Bitcoin?
There are three mandates for the new administration. One is DOGE. The other one is the deportation of illegal immigrants. And third one is tariff. Theoretically, all three things can lead to better growth engine for the US. Theoretically, the American first approach on international front and domestic front lead to good outcomes down the road. And we talk about how the previous administration were utilizing the unique hegemonic dollar position to do everything in a relatively easy way. The new way have a potential of having a higher growth down the road, solve some of the hardcore problem we face today. But the path to get there among each of the three things is highly challenging because there is a possibility the medium-term result is different from the long-term result. That's why I call this period starting from December, the macro game theory environment. You can no longer control your destiny all by yourself. We depend on how other people respond to your initiatives. That's on the tariff side. The tax-related support for economic growth tend to be a slower process. Remember, when people don't do well, that impact is felt right away. And when people do well, it's actually take a longer time for that positive effect to play through. The pain is always more memorable than the gain. That's kind of true with all the economic system or financial system. Because of that potential divergent trend between medium term and longer term, we also talked briefly about US dollar start to show some symptoms of liquidity problem. The reason we did not experience continued liquidity problem is a result of multiple factors. QT was cut in size in June of last year. Then July, we had the rate cut expectation built into the system. And Fed cut 50 basis points on September 18th and cut two more times in November and December. There is a stronger inclination by Fed to claim that they're not going to cut more. The market not expecting them to cut more. That means potential liquidity concerns, if you look at reverse repo size, the TGA size, have some support for liquidity, but they are not sufficient unless we do some major changes. And that liquidity issue is also showing up in global markets. For example, if you look at India, they started the decline in late September. Rupee was breaking out of the long-term trading range. It was trading at around 83, but quickly went to 86. It had been there for 2 years, but broke out of that range on the weakening side. At the same time, that market is declining. I used to be so bullish of the Indian market, but around summer, I see liquidity concern. The potential is global restructuring of the entire trading system. All that caused many of the previous trends to be reassessed. I would say dollar liquidity condition is a worrisome sign.
We have covered so much ground, from China to India to the US, from gold, Bitcoin to all the other assets. It's just amazing discussion. One thing that I walk away from our discussion is you think that China's economy would take much longer to recover, even the bottom hasn't been there yet. But at the same time, the stock market has been pulled out of the bottom by the government's injection of liquidity, and that is a bright spot in China's economy. If I'm not right, please correct me.
Yeah, you are right. In many countries in the past, including financial crisis, remember that QE helped the market right away when the economy was stuck in low gear for years after that. Japan had that issue too, even though there was a lost decade, but there were some substantial rallies. I lived in Japan for a couple of years in the early 90s. I was working for Morgan Stanley, and we were witnessing some interesting counter-cyclical rallies. So in this case, it can happen.
Great. I have tons of questions, but I have to stop here. Do you have any blog or Twitter or LinkedIn account that audience can follow?
The audience can follow me on LinkedIn, which is my name. Shengbei is Shengbei, first name, and last name Guo. I set up a Twitter, it's Shengbei 3, so it's Shengbei number 3.
It's wonderful to talk to you. I learned so much.
Thank you, Coco. It's so much fun to chat with you. I hope we can talk more in the future.
Thank you for listening. Your support means the world to me. Share this episode with friends and family, and don't miss out on my newsletter, worldledger.substack.com, for the latest updates. See you next time. Bye-bye.